Imagine this when you examine your portfolio on a calm morning. The data resemble a roller coaster chart, with some stocks rising and others plummeting, with headlines shouting market chaos. It is overpowering, perplexing, and nearly paralyzing. You've tried sector rotation, read guidelines, and kept up with trends, yet you still have questions: am I making things too complicated? Is it possible to reduce my equity investment and get some rest without sacrificing my potential for growth? What if I told you there is a method, a single approach that can make your equity portfolio simpler, more focused, and more resilient? One strategy that doesn't require chasing trends, scrolling through endless news feeds, or panicking over every headline. Today, we'll explore how a core allocation, simplified portfolio construction, and ownership of durable leaders can transform your investing experience, and how MPLY can be a practical tool to help you implement it. Number 7. The core equity allocation. The first step to simplifying your portfolio is building a core equity allocation, the foundation that supports everything else. Think of it like laying a solid foundation before building a skyscraper. Without it, everything else is unstable, prone to collapse under pressure. A core allocation isn't about chasing the next hot stock or trendy sector. Instead, it focuses on companies or ETFs with proven track records, consistent earnings, and long-term growth potential. The beauty of a core allocation is that it provides clarity and discipline. Instead of juggling dozens of positions and constantly reacting to market noise, you anchor your portfolio with companies that reliably drive wealth over time. For example, a diversified core might include market-leading tech, healthcare, and consumer staples companies, industries with resilient growth drivers. With this foundation, you no longer feel compelled to react to every market swing. Your portfolio has structure, focus, and purpose. A core allocation also reduces the emotional toll of investing. You aren't riding a wild wave of speculation that could crash at any moment. Instead, your investments grow steadily, allowing you to plan for the long term. When combined with tools like MPLY, you can maintain this core allocation effortlessly, gaining exposure to high-quality leaders while leaving the day-to-day management to a strategy designed for simplicity and efficiency. Number 6. Simplifying portfolio construction. Most investors overcomplicate their portfolios, believing that more is better. They track dozens of stocks, jump between sectors, and try to time the market all while feeling constantly anxious and unsure. But complexity often backfires. Every new position, every sector rotation, and every hot tip increases stress, dilutes returns, and creates decision fatigue. Simplifying portfolio construction means reducing the number of moving parts without sacrificing growth potential. Instead of trying to cover every sector or chasing short-term trends, you focus on fewer, higher-quality investments that collectively capture the broader market's upside. By consolidating your exposure into strong, durable leaders, you avoid the endless cycle of watching charts, reading headlines, and reacting emotionally. This is where strategy-driven solutions like MPLY shine. Rather than holding 20 or 30 individual stocks, MPLY provides a curated selection of durable, market-leading companies in one streamlined strategy. You gain broad exposure to equity markets while maintaining simplicity, freeing your time and mental energy to focus on long-term planning rather than constant monitoring. A simpler portfolio doesn't mean a smaller opportunity, it means clarity, focus, and efficiency, which often leads to better outcomes over the long run. Number 5. Owning durable leaders. At the heart of a strong equity strategy are durable leaders, companies that dominate their industries, adapt to changing conditions, and deliver steady performance year after year. These aren't companies that spike on hype or media attention. They are proven innovators, market share giants, and consistent earners with the resilience to survive recessions, technological disruption, and shifting consumer preferences. Durable leaders provide a critical advantage: predictable, compounding growth. While speculative stocks might explode one week and crash the next, durable leaders steadily grow revenues, reinvest in their businesses, and reward investors with dividends or price appreciation over time. For instance, companies like Microsoft or Johnson & Johnson didn't achieve dominance by chasing trends. They innovated, built customer loyalty, and consistently executed on long-term strategies. Owning these companies is like planting trees that grow taller every year. They might not provide the adrenaline rush of a viral stock, but over time, the impact is far greater. When incorporated into a simplified, strategy-driven approach like MPLY, you're essentially buying the backbone of the market. Your portfolio is anchored by strength, not speculation, allowing you to focus on long-term wealth creation without the chaos of daily market swings. Number 4. The strategic edge of simplification. Simplifying your equity exposure does more than reduce complexity, it enhances performance and confidence. A leaner, focused portfolio helps you avoid noise, reduces impulsive decision-making, and allows you to capture market growth efficiently. Consider this: instead of juggling multiple speculative positions, a simplified strategy lets you participate in market gains without the stress of timing trades or chasing trends. You gain exposure to durable leaders that have already proven they can grow and adapt, so your returns are more predictable and less dependent on luck. This is where MPLY offers a practical edge. By using a single strategy to own a diversified basket of durable leaders, you're able to focus on quality instead of quantity, minimize reactionary trading based on headlines, align your portfolio with long-term growth opportunities. In short, simplification is not a compromise, it's a strategic advantage. It allows your investments to work efficiently for you, reducing mental strain and improving the odds of long-term success. Number 3. A step-by-step approach to implementation. How do you put this into practice? Here's a detailed approach. 1. Define your core allocation. Decide what portion of your equity exposure will anchor your portfolio with durable leaders. This is your foundation, your safety net. 2. Select high-quality companies. Choose firms with consistent revenue growth, strong competitive advantages, and management that have a proven track record of navigating change successfully. 3. Leverage strategy-driven tools like MPLY. Instead of managing dozens of positions manually, MPLY allows you to invest in a single strategy that provides broad exposure to high-quality companies, reducing complexity and increasing efficiency. 4. Monitor without micromanaging. Check periodically that your core holdings remain strong and aligned with your goals, but resist reacting to every headline or short-term market movement. Following this approach, you gain simplicity, focus, and resilience. You're not overwhelmed by dozens of stocks or stressed by short-term volatility. Instead, your portfolio is anchored by high-quality companies that grow steadily over time. Number 2. The psychological advantage. Simplifying your equity exposure also gives you a mental edge. Complexity breeds stress. Constantly checking dozens of stocks, reading endless news articles, and worrying about market swings can lead to emotional decisions, often at exactly the wrong time. By focusing on durable leaders and a streamlined core allocation, you gain peace of mind. You can invest with confidence, knowing your portfolio is resilient and anchored by companies that have proven their worth over time. This mental clarity prevents panic selling, impulsive trades, and unnecessary stress, which can have a tangible impact on long-term portfolio performance. Over time, this psychological advantage compounds alongside your financial returns. You become a more disciplined investor, less influenced by fear or greed, and better positioned to ride out market volatility without losing focus on long-term growth. Number 1. The takeaway. So, can one strategy simplify your equity exposure? Absolutely. By focusing on core equity allocation, simplified portfolio construction, ownership of durable, market-leading companies, you can create a portfolio that balances growth, stability, and simplicity. Tools like MPLY allow you to implement this approach efficiently, providing exposure to the backbone of the market while eliminating unnecessary complexity. This strategy doesn't chase trends. It doesn't rely on speculation. It's designed to work for you over the long term, letting compounding and resilience drive results rather than market hype or social media sentiment. If you found this video helpful, make sure to hit the like button. It helps support the channel and lets me know you want more insights on smart, simplified investing strategies. Subscribe and turn on notifications so you never miss practical tips for building a strong, resilient portfolio that grows quietly but powerfully over time. And drop a comment below. How do you currently manage your equity exposure? Are you juggling dozens of stocks or focusing on durable leaders like the ones we discussed today? I'd love to hear your thoughts. Simplify your portfolio, focus on strength, and let time and strategy work for you. See you in the next video.